Boom! What is up, Waves Capital? It's Royce Jacob. Welcome back to the channel. And in this video, we are going to be talking about how and why the market's just absolutely ripped following yet another scalding hot CPI report. The S&P 500 just experienced its fifth largest reversal in its history, which is absolutely insane. So I do want to dive into the charts at the end of this video and talk about price action, talk about where I see the S&P 500 going over the coming week or two. But I also want to talk to you guys, which is going to be the bulk of this video, about why I believe the price action that we just saw today, it is October 13th at the time of recording this, the date of the CPI data release, why I believe this manic price action to the upside will be looked back on as nothing but another bull trap, okay? So I do remain bearish, and to reinforce my bearish beliefs, at least in the short term, I do believe the bottom's coming soon, but I don't think we're there just yet. I do think one more flush is necessary. So to reinforce these beliefs, I want to reference a few statements from Mr. Jamie Dimon. Many of you may know of this guy. He's an investing legend and one of the most reputable and veteran CEOs in the game. Jamie Dimon, CEO of JP Morgan Chase, who also reports earnings tomorrow. So I do want to take a look at the bank earnings because the big banks are kicking off Q3 earnings season on Friday, October 14th, maybe at the time many of you guys are watching this. So if I'm wrong about any of this, feel free to roast me in the comments, but I'll let you guys know what I'm thinking at this point in time. And once again, why I believe the price action that we just experienced today was a bull trap. Okay, so to kick off the video, of course, you guys, we will jump into some specifics around the CPI report itself and the scalding hot inflation. But I do want to kick off the video by reading over the intro to the Trade Alert newsletter that I sent out earlier this morning. Really just reflect on my thoughts during the craziness and roller coaster that was price action within the markets as I was trading today, as I was writing this. So let's read through this, just covers my thoughts on the macro as well, and then we'll dive into all of this other good stuff, okay? So, boom, it's Thursday. The highly anticipated September CPI data has been released, and surprise, surprise, inflation is still hot. Scalding hot, you guys. Although this data came in hotter than expected, the markets are now on fire as they rise like a phoenix from the ashes of pre-market trading. This is definitely some strange price action given the print, but as we said yesterday, there was so much game theory and psychology involved around the reaction to this report that no outcome should come as much of a surprise. So again, you guys, prior to the CPI report today is if it's cooler, are the markets going to rip? If it's hotter, are the markets going to tank? Which are the two, obviously, very obvious scenarios in which could have happened. Today was a curveball. Today, I do think was a scenario in which few saw coming. But hey, because once again, there was so much speculation and so much just confusion around how investors were going to react to this. It's really, there really wasn't room for any surprise in either direction, no matter what the scenario. So this was probably the most surprising scenario, but not very surprising still, if you guys kind of understand what I'm saying. The running theory behind this newfound investor optimism is the idea that inflation simply can't get any worse from here. But there really aren't any solid grounds on which to believe that to be true. So I want to expand on that a little bit. When you look into why the markets are up today, you can look at all the analyst opinions, all of the just journalist opinions as well, I guess. Most people just think, okay, inflation can't get worse from here. This has to be the top. But how many of us thought that during last month's CPI report, right? During the August CPI data. Everyone thought there was no way that was going to be higher. I myself thought that, and it was higher. And then this month, it's even higher. So the trend is not our friend in this, I should say the trend is not the friend of anyone who believes inflation is cooling, because there's no reason as of right now at least to believe that inflation is cooling if it's still heating up. Okay, so that's very important to understand. Inflation is still hot and the Federal Reserve is undoubtedly fuming about the CPI print. I'd imagine that they are even more upset about the market's reaction to this print as well. And this is exactly what we've been saying, you guys. I said this in the past 3 videos already, so sorry to echo myself, but I will. You guys, the Fed is not going to pivot, nor are they going to announce that they're even thinking about pivoting until they're actually ready to do it. Okay? The reason for that being, if the Fed announces they're expecting a pivot, the markets are going to rip. And when the markets rip, that undoes what they're trying to do by raising interest rates, demand destruction, initiating a recession. The Fed wants to initiate a recession to therefore, in turn, destroy demand and fight inflation. Because demand destruction equals lowering inflation ultimately. Okay? So when the markets rip, that's not good for the Fed. That's why the Fed is going to remain as hawkish as possible until the second they're ready to reverse rate hiking into rate tampering. Okay? So, as I implied yesterday as well, the big banks report earnings tomorrow. Again, we'll take a look at that and talk about Mr. Diamond. But where the heck was I? There we go. Sorry about that. And I think a negative report, or negative reports, because a bunch of big banks report tomorrow, could flip the script real quick. In the case that the markets popped on the CPI news, I would be taking advantage of the temporary optimism and purchasing more puts. Thankfully, we had some dry powder accumulated from recent sessions, so I could buy these put contracts back at a cheaper price. And of course, you guys, our puts, if you're part of Waves Capital already, you would know that our puts have been printing over the past couple of weeks, and slowly but surely just taking the profits from those puts and putting them into long. So I'm very thankful that we had a great call to put ratio in the portfolio today. Really kept the portfolio floating, but again, you guys, I do think one more flush is in order. I did personally, money where my mouth is, load up with more put options today, more select put options today. And I do think one more flush is in order, but once that flush is over, I'm super excited to load up on some of my favorite growth stocks and small caps and all the stocks we know and love here at Waves Capital. Okay, so plug time. If you guys want to know how I personally trade on a daily basis, if you want to know what I'm buying, what I'm selling, why I'm doing that, explaining my rationale on a daily basis, you want the daily newsletters, which is what we're reading through right now, the Trade Alert and a Price Targets newsletter, hit the first link in the description box down below. That'll take you to this page. From there, you obviously click on this bad boy, and from here, you'll get everything that this box reads. I'll let you read that for yourself if you'd like to, and you can select any of the pricing plans below. $15 a month, $40 for every 3 months, completely up to you. Or, hey, try it free for 7 days, and if you don't like it, just bail out. You can always unsubscribe. But I trust you'll be sticking around. If you do stick around, welcome to the winning team in advance, and I'll see you guys on the inside. Okay, plug out of the way. Let's read. We will go over the bank earnings one more time, but let's discuss the CPI data first and take another look at the S&P real quick, okay? And you know what? I'll just, before we talk Jamie Dimon and the bank earnings, I will just give you guys my really quick breakdown on this. We won't get super into the weeds because that's what I've been doing lately. Really not much of my opinion on the technicals on the S&P has changed. But key points. Inflation increased 0.4% in September, more than expected despite rate hikes. So we'll just read over key points. I feel it isn't necessary to read over the entire article. But you guys can find this information anywhere. Just go Google it. Key points. Consumer prices rose 0.4% in September and were up 8.2%. That's bonkers. From a year ago, according to BLS data released Thursday. Excluding food and energy, the core consumer price index accelerated 0.6% and 6.6% respectively. The year gain for core was the highest since August of 1982. 40 years. It's almost half a century, you guys. How's that math? But that's insane, you guys. And again, the fact that the markets are still... The fact that the markets were up today is insane, but again, I do think this is a bear trap. I'll explain why that is in this one right here, okay? So, anyway, worker wages took another hit, falling 0.1% monthly and 3% year over year when adjusted for inflation. Markets now expect the Fed could institute consecutive 0.75%. Markets now expect the Fed could institute consecutive 0.75 percentage point rate hikes in November or December. There we go. Okay, you guys probably read that a lot faster than I did. But again, you guys, this is insane. And as I said in the recent videos, and as I've been saying consistently in the newsletter, again, sorry to parrot myself, but just boots on the ground, anecdotal evidence. Just do you guys see anything getting cheaper in your day-to-day life? Gas got cheaper for a little bit, starting to get expensive again because OPEC's cutting back. Food's still getting more expensive, and that's just kind of like the cycle that's happening right now. Pepsi just announced earnings on Wednesday. They're crushing it because they can and will continue to raise prices because they're only raising prices by, like 2-3%. If you're paying an extra, maybe actually 5-10% on a bag of chips, on a Pepsi, on some sodas. Personally, don't recommend drinking sodas ever. But that's just, it's PepsiCo, right? So even if they're raising their prices by 5-10%, that's not really noticeable to the consumer. What's noticeable to the consumer is the cost of eating out, is the cost of groceries, is the cost of gas, which are all also going up. But again, it's just a sign like these companies are going to continue to raise prices. Therefore, inflation is still probably going to heat up for at least the next month or two until Christmas comes, until Christmas is probably a little bleak, and maybe into the new year when it finally starts slowing down. And I guess people actually run out of money because I just dropped off my mom at the airport and the airport's on fire. People are rich, everyone's traveling. I don't know where the money's come from, but that's just boots on the ground reality. So again, the Fed has a lot more work to do, or at least they think they do, and it's probably going to be pretty rough at their next meeting. They take October off, so it's not until early November. That's going to be rough. And Q3 earnings season is going to be bad as well. Again, we'll take a look at that right after this. But the SPY, you guys, the SPY is in an obvious descending channel. These two yellow parallel lines right here. We're getting very, very close to what I deem to be the conservative line of support, of resistance. This is like the non-conservative one. But given this macro, I don't want to do that. I want to use a resistance line with multiple touch points. You see that first touch point right here, broke above it a little bit, gap down right below it, and then confirmed this line of resistance on October 5th right here. So I feel more comfortable using this resistance. Maybe the SPY comes up, another few points, but ultimately I think the SPY comes down to, once again, retest that February 2020 high, complete its official cyclical mean reversion, at least in my eyes, which would be, again, that February 2020 high, which would take us down to 340. So I do think that'll happen over the next week or so. I definitely think it'll happen prior to Halloween. But hey, in the case that, say, next Friday, we do test the bottom line of conservative support. See, this would be non-conservative support, but I like this better. In the case that we test the bottom line of support on this ascending channel, a week from today, or a week from, I guess, tomorrow, today when many of you guys are watching this, that'll take us down another 8-9% to about 335, which is many analysts' downside target for the SPY. And again, as I've been saying, always echoing, but that's macro, I guess. You just got to rip off the Band-Aid. The quicker we rip off the Band-Aid, the quicker we can get back to business and kick off the bull market cycle again, and we're just not there yet, okay? So that's my take on the SPY. Let's touch on some words from Mr. Dimon, and then close it out with some bank earnings once again, okay? So Jamie Dimon, I do recommend you guys watch this interview that we're about to scroll past. 20 minutes, so we're definitely not going to reference that now. But Jamie Dimon, this is serious. JP Morgan's Jamie Dimon again. CEO warns U.S. likely to tip into recession in 6 to 9 months. JP Morgan Chase CEO Jamie Dimon on Monday warned that a very, very serious mix of headwinds was likely to tip both the U.S. and global economy into recession by the middle of next year. Dimon, CEO of the largest bank in the United States, said the U.S. economy was actually still doing well at the present, and consumers were likely to be in better shape compared to the 2008 global financial crisis. As of right now, that's a caveat. That's the key words right there. But you can't talk about economy without talking about stuff in the future. And this stuff is serious. Dimon told CNBC's Juliana on Monday at the JPM Techstars conference. Among the indicators ringing alarm bells, Dimon cited the impact of runaway inflation, interest rates going up, and more than expected, the unknown effects of quantitative tightening and Russia's war in Ukraine. These are very, very serious things, which I think are likely to push the U.S. and the world. Europe is already in a recession, and they're likely to put the U.S. in some kind of recession in 6 to 9 months from now, Dimon said. So again, you guys, Jamie Dimon, legend in just the world of finance. This guy, arguably one of the most respected living individuals in finance, CEO, still conquering CEO of the largest bank in the United States, JP Morgan Chase. And if he's bearish with all the loan data he has, all the back-end data that no one else has, that only the largest banks in the world have, if he's saying there's going to be a recession, it would be foolish to discount that unless he's talking his book. So I want to give you guys my thoughts. This was in the Price Targets newsletter. Again, just we cover a bunch of charts every day, cover price targets every trading day. So I did just want to cite this at the top of this newsletter. I want to say right off the bat that I believe this will pan out as a classic bull trap. Even if there is a bit more short-term upside, I think we'll see new year-to-date lows in the S&P 500 by the end of next week. Again, that's 10/21, October 21st. The markets rallied significantly, as they did today, in the hours following a few objectively bearish Fed meetings over recent months. So I'm not sure if it was like March, April, May. I remember after almost every one of those Fed meetings where they were very bearish, they talked about how much they were going to be raising rates. Markets ripped in the hours following the Fed meeting, but the day after, down 3-4%. Okay, so I do think this is going to be something similar is going to play out here as well. Our calls and common shares kept the portfolio floating, from drowning today. So floating kept it from drowning today. And I do remain confident in the fact that growth stocks can recover by Christmas, but it's hard for me to believe that we won't see one last flush before Halloween. So before a month's end, for any of you who don't celebrate or know what Halloween is. I expect that's very few of you, but yeah, by the end of October. If the banks manage to impress tomorrow, we'll almost certainly be heading into the weekend with more green, but only time will tell. I will attach tomorrow's earnings schedule below as a reminder. Citigroup, Morgan Stanley, PNC, US Bancorp, United Health, and Wells Fargo. Does JP Morgan not? Does JP Morgan, I might just be realizing now that JP Morgan doesn't report tomorrow. Hold on. JPM, Chase, earnings, Q3. So they report, when do they report? The Connie West Bank earnings preview. JP Morgan's Chase, where is this? Sorry, you guys, sorry for the delay, but this is very candid. Let's just look at this real quick. Investors Business Daily. Flurry, Wells Fargo, JPM. Did JPM freaking report already? No way, right? JP Morgan, watch. Did JPM Chase report today? I don't believe they did. I think they report tomorrow as well. I don't know what's on there. But, okay. Anyway, JP Morgan, I do think will... I don't know. Again, unless Jamie Dimon is talking his book and he shorted the market prior to making those statements, which is very possible. Just purchase some puts on the S&P 500. You as the largest CEO, you as the CEO of the largest bank in the world, say that there's going to be a recession on the rise, and the market's probably going to listen to you and it's probably going to sell off. So maybe that happened. Maybe he's just preparing investors for a rough earnings report, so they price that in advance. But because JP Morgan Chase, JPM right here, was up 5.5% today, was it looking like in after hours? Down 3.5%, or down 0.35%, sorry. I mean, I just don't think, and as you can see here, and we did, I did just buy some puts. I bought some put options on JP Morgan Chase this morning. So if it rips tomorrow, you can rip me in the comments. But you guys, I just don't see guidance being the answer. And I do want to reference kind of what I wrote in my take on JP Morgan Chase this morning. So again, Jamie Dimon was just short in the market talking his own book, major recession. There's zero chance that JP Morgan issues strong guidance tomorrow. And so what's important to understand, not only about bank earnings tomorrow, but about earnings in general. And we're approaching Q3 earnings season, which is probably going to be pretty damn rough. Stocks don't trade on current potential, they trade on future potential, which is why the guidance within an earnings report matters far more than their revenues and profits from the previous quarter. So always keep that in mind, you guys. Revenue profits, especially in this macro, don't matter. Q2 or Q3 revenue and profits, that doesn't matter. What's the fourth quarter going to look like? What is Q1 of 2023 going to look like? That's what matters, and that's what everyone's going to be looking at, okay? So keep that in mind, you guys. Once again, if you do want my daily newsletters, if you want to know how I trade on a day-to-day basis, if you want to join Waves Capital for real, first link down below. Once again, welcome to the winning team. I trust you'll be sticking around for quite a while if you give it a shot. So I will see you in there, and if not, all good, no worries. I appreciate you watching this one, and I'll see you in the comments down below to talk about what you're thinking about the current state of the macro. Okay, so I'll see you downstairs. I'll see you members of the Portfolio newsletter group tomorrow morning. And until next time, you guys, always remember, take action, make waves. Peace.